Fantastic. Module 4, we learned about financial institutions and financial accounts. We learned about 2 types of financial institutions. We had depository institutions and non-depository institutions. It says it right there in the name. A depository institution is an institution where customers deposit their money. That's the main source of profit, is the interest on these. I'm sorry, I'm saying that wrong. The main source of profit is the interest that they collect on the loans to people, because people will deposit their money into the bank, and then the bank will take that money and loan it out, and then they make profit on that. So, you know, they might loan out money for a car loan, and they're going to charge, say, 6% interest on this car loan. You have a savings account at that bank, and you're earning 1% interest on the savings account. So that's where they're making their profit. They're taking your money, and then they're going to loan it out for a higher rate of interest than what they're paying for you, and everybody wins then. You're getting your interest, they're getting their interest. With depository institutions, these are FDIC insured for up to $100,000. So up to $100,000, if something happens, they're going to insure your money so you don't lose it. You also have non-depository institutions, and those focus more on just providing loans and other money management services. They receive their money from sources like mortgages, finance companies, and insurance companies. Okay? Any questions on that, or are we good to move on? We're going to get a little deeper into these. All right, types of depository institutions. The one that you're probably the most familiar with would be a commercial bank. A commercial bank would be something like Wells Fargo, SunTrust, TD Bank, any of those. Those would be commercial banks. They're most well known. They're funded through their deposits into checking and savings accounts. So most likely, if you have a savings account right now, you probably have it at a commercial bank. If you don't have it at a commercial bank, then chances are you may have it at a credit union. Credit unions are member-owned institutions. They're nonprofit, so they're able to keep their costs down, and they're able to offer higher interest rates on their savings accounts, their CDs, different things like that. Okay? There's also savings institutions. There's savings banks. These are stock-held savings and mutual savings. Then there's savings and loan banks. Those are, they receive their money from deposits, and then they make loans, and 70% of their deposits are used to make mortgages. So that's where they're getting their money, is off the interest on the mortgages that they send out, or that they give out. Web-only institutions, the one that always comes to mind is Citibank. Citibank, there's no physical location. If you have cash to deposit, you're going to go to an ATM, that's a Citibank ATM, and you'll deposit your money through that ATM check, so you can take a picture of them and deposit them that way. All of your transactions are done online. Because everything's done online and there's no physical location, the overhead is lower, and they're able to offer higher interest rates on their savings and CDs and different things like that. The risk of that, there's a greater risk of fraud and scam because of there not being the physical location, and it all is online, that there is that risk. So you want to be really careful if you ever do decide to use a web-only bank. Now, the other day I was doing this, and I had a student ask, web-only institutions are different than just doing your bank online because they don't have a physical location. Exactly. I do all of my banking online, but my bank actually has a physical location. So that is not a web-only institution. It's their online service. One of my students the other day asked what overhead was. That's a very good question. So if you were thinking that, I'm going to go ahead and answer that. Overhead is the cost that a company has to pay for things like their building, their land, rent, electricity, water, anything like that. When there's no physical location, that cuts down on the things that the company has to pay for. So because it costs them less to run their business, they're able to offer the higher interest rates, which will then bring in more customers, and then that's better for them. If we're good with that, give me a smiley. Fantastic. Now we have our non-depository institutions. One type is a mutual fund company. This is an investment company. They sell shares to individuals and they pull the funds together and then they buy financial securities. So they're going to take everybody's money, put it together, and then buy the financial securities. We also have brokerage firms. This is a place where they manage and facilitate the purchase of stocks, bonds, and other types of investments. So say you want to invest in the stock market, but you don't really feel comfortable doing that yourself. So you could go to a brokerage firm and they will do that for you. Now, they're also going to charge you a fee, or they're going to take a commission because they have to make money too. Remember, it's capitalism, so they need to make a profit. So that's how they make their profit. Then we have life insurance institutions. These are where individuals can purchase life insurance policies and they pay the insurance company premiums. So every month they'll pay a premium on this insurance policy, and that's how the company makes their money. They take those premiums and they invest that money so that they can hopefully earn a profit. And sometimes they also offer savings and loans. All right, give me a smiley if you're good with that. Fantastic. We've got 4 types of financial services that we see at a lot of our banks. One is savings. This is a safe way to store your money, but not only that, you'll earn interest. Occasionally fees may apply. Usually what they'll say is you need to keep a minimum balance. If you go below, say, yes, better than under the mattress. If your balance goes below, say, $300 or $500, you know, depends on the account that you're using, then you'll start getting charged a fee. But it's nice when you do earn that interest. It's not usually a lot of interest, but it's better than nothing, so your money is always growing. There's also payment services. These would be like checking accounts where you can write checks or you can use debit cards. Not a lot of people write checks too much anymore. Most people do use their debit cards, but occasionally there's a time that you do have to write a check, so you have to mail it to somebody. So these are payment services that you could have through a bank. I pay most things online. Most of my bills are paid online. It's just easier because I don't have to think about it. But you do have to be careful when you do that. I have found that sometimes the bank makes mistakes and they don't send out your payments when they're supposed to, or occasionally they just have glitches in their system. So if you are going to have a checking account and you are going to pay things online, it's always a good idea to pay very close attention and check your account often. Another type of service that they offer are loans. These can be short-term, long-term. They could be mortgages, car loans, education loans, anything like that. And then a lot of times we'll also offer financial services. This would be financial planning, tax assistance, or even investment advice. So give me a smiley if you guys are all okay with that. Looks like Alyssa might be asking a question. That can happen, absolutely, especially if you have it set up to go each month. If you have something set to go, say, on the 15th of every month, and the 15th falls on a Sunday, they'll most likely take it out the Friday before. So instead of being taken out on the 15th that month, it will be taken out on the 13th. So like I said, it is very important to always make sure if you're going to use that you do check it often. Okay, we have different types of accounts and investments. We have savings accounts that we just talked about. These are where you can earn interest and you can withdraw usually at any time. You will be limited as to how many withdrawals you can make. You can't just withdraw money several times a day like you can with a checking account. There are limits, but if you have an emergency, you can go on in there and take your money out, and you are earning interest. With a checking account, sometimes you will earn interest. Occasionally you do find a bank that does give interest or offer interest on their checking accounts. But you can also withdraw your money at any time, and there's usually not a limit. As long as you have money in the account, they will stop you if there's no money left in the account. Okay, we have certificate of deposit, or a CD. CDs have a maturity date. That means that you're going to put your money into this, and you're not allowed to take your money back out until a certain date, which is called the maturity date. These could be all different times. It could be, 3 months, 6 months, a year. It could be more than that. And usually, the longer you leave it in, the higher rate of interest you're going to receive. These are less liquid than a savings account, where you can go in and withdraw your money at any time. So if you have an emergency and all of your money is tied up in a CD, you will not be able to just take it out without paying some type of a penalty. We also have money market mutual funds, and this is where you invest money in different financial assets. And then there are bonds. We talked about bonds. These are issued by the government to raise money for projects, and you can earn interest on those. And then we have retirement accounts. Retirement accounts are important. 401k accounts are partially funded by your employer, but all the money that you put into a 401k is before they tax you on it. So say you're putting money into a 401k every pay period, you have a certain amount of money that's coming out of your paycheck and it's going into your 401k, you're paying income tax only on the money that you're receiving. You're not paying income tax on the amount of money. Say you're having $100 every pay period go into your 401k. You won't pay taxes on that $100. So if you decide that you want to take that money out of your 401k before you retire, before it's time, you will pay a penalty because you've not paid interest on any of that money. Okay? Now, when you put your money in a retirement fund, usually what they do is that money is then invested. So that's where you're earning off of your retirement fund. That's one of the ways that it's growing. We also have 403Bs. These are for employees of nonprofit organizations. So school teachers can have a 403B, and this has similar things. You can put money in it before taxes are taken out. Yes, you can usually, with a 401k, you're limited as to how much you can contribute each year. With a 403b, you're usually allowed to contribute more. So that's why it's a nice thing for government employees or nonprofit organizations to be able to do this, because you can put more money away for your retirement. And I know it seems silly for you guys to be in high school and thinking about retirement, but it's never too early to learn about that. All right, give me a smiley if you guys are good with that and ready to move on. Fantastic. Yes, start early. We've got the 4 Ps. These are the things that you want to take into consideration when you're choosing a bank. The first P is going to be product. What services do they offer? We just talked about all the different services. You may not be interested in all those different services. You may only want a savings account. But think a little bit ahead. Think a couple years ahead. You want to think in the future also. Maybe you don't want a savings account right now. You just want a checking account, but maybe in a year or so you may be interested in a savings account as well. So you really want to look at all their different services that they offer. You want to look at price. Do they have a savings account that has, a minimum balance and you're going to be charged a fee? What is the interest rate that they're going to pay you on your savings account? If you're going to take out a loan from that bank, what's the interest rate that they're going to charge you? So you want to look at fees and interest rates. You've got the interest that you're going to gain from, say, a CD or a savings account, and then you also have interest that you would pay for a loan or something like that. You also want to look at place. This is the location not just of the branches but of the ATMs. If you're the type of person, I personally do not use ATMs. But if you're somebody who likes to use ATMs, you want to make sure that there are some that are in your area. You don't want to have to drive too far to use the ATM. You also want to know that if you're the type of person who goes out without cash and has to use ATMs often, you want to make sure that they have a lot of them, because if you go to an ATM that's not part of your branch, you're probably still going to get a fee, but you're going to get a higher fee if you're not from that bank. So say you're banking with SunTrust and you use somebody else's ATM, you're going to be paying a higher fee. And I haven't done it in so long, I don't even remember what the fees are, but they're, I think, a couple dollars, so those definitely add up. You also want to look at the people, the customer service. If you're going to have an issue with your money, you want to make sure that there's good customer service. Here's a perfect example. This is so funny because, I mean, it's not so funny, but it's funny that this just happened yesterday. Yes, you want to make sure that they're knowledgeable, that they know what they're doing. My husband just made a deposit in the bank a couple days ago, and then I got online and I'm looking through and I was like, huh, I thought you made a deposit the other day. And we should usually see that within minutes. We should see it online. And so he came over and he looked and he's like, oh yeah, I did. So he ran and he got his receipt. When you make a deposit, you always want to make sure you save your receipt. And he looked and here they put in the wrong account number. So they had deposited our money into somebody else's account. Now had we not checked, we would have lost that money and somebody else would have been like super excited because they had gotten a nice gift the other day. And they were probably disappointed. They probably saw it in there and then it disappeared. But now when my husband called the bank, within minutes that was taken care of. Okay, so that's the kind of thing that I look for. If there's going to be an issue, I want a bank that's going to take care of it quickly. They're not going to pass the buck. They're going to you know, just find what the problem is and fix it. So go ahead and give me a smiley if you guys are good with the 4 Ps, and we will move on. Fantastic. All right, we have problematic institutions. These are institutions that we see often. We see commercials for them. We see them on the side of the road in different strip malls and different things like that. And you may not have known a whole lot about them. These are all, you know, there may be situations where these types of institutions could come in handy. But for the most part, they're not financially wise to use. A pawn shop, fun to go in. If you're going to buy stuff. But what pawn shops do is they give you a loan based on the value of an item that you bring in there. But they're also going to charge you high fees. And if you don't pay back the loan, they sell your item. So say you have a I don't know, my husband talks about Gibson guitars, so I guess they're good and expensive. So say you have one of those, and you go into the pawn shop because you need money quickly. Your electric is about to get shut off and you don't have any money to pay for it, so you've got to go into the pawn shop and you're going to take a loan from the pawn shop. You're going to give them your guitar. They're going to give you an amount of money. I can guarantee you the amount of money they're giving you on that guitar is not what the guitar is worth. They tend to be under $100. Okay, that I did not know. That's good to know. So they're going to give you a loan based on the value of the item, but it's going to be like a percentage of the value of the item. It's not going to be the full value of the item, because if you don't pay back the loan, they want to be able to sell that, and that's how they're going to make a profit. They're also going to charge you high fees. So that's how they're also going to make a profit. So you may get to pay off your electricity, but it's going to, in the end, cost you a lot more money than if you had just budgeted out the money that you needed and paid your bills on time. We also have check cashing businesses. If you have poor credit or bad credit, sometimes it's harder to get a checking account. If you don't have a checking account, you cannot go into just any bank and cash your paycheck. So sometimes you'll have to use these check cashing businesses. This is why you'll learn in Module 8. It's very important to keep good credit, to have a good credit score, to have a good credit report. You don't want to have bad things on your credit report. So if you don't have a checking account, you can go to these check cashing businesses and you can cash your paycheck, or you can just write a check and cash this paycheck. But they're going to charge you high fees. Now, if I take my paycheck from FLVS and I walk into my bank and I cash my check, I don't get charged a fee at all. Okay, but if I went into a check cashing business, I would be paying a lot of money to cash that check. We also have payday loans. 2 to 3% of the overall amount, which really adds up. It doesn't sound like a lot, and some of them charge more than others. It really depends. Payday loan businesses, this is where you get a cash advance. You know you're going to get paid on Friday, but you need the money on Monday. You're basically signing over your check to these people, and then they're going to charge you, again, high fees. And then if you don't pay it on time, you're going to get charged even more fees. So in the end, it's going to cost you more. All right, this one ought to look familiar. This was a question from 406. Rent-to-own services. These will target low-income families because low-income families will typically not have high-end electronics and furniture and different things like that. But we all want those things. So they can go into a business like this. Anybody can go into a business like this, and you will rent the item to eventually own the item. So you're paying pretty much, usually weekly, you're paying on this item until you have it paid off, or if you stop paying, then they take it back and you lose everything that you've paid on it. Now you're going to pay huge interest rates on these items that you're renting to own, and in the end, you're going to be paying probably about 2 to 3 times as much. The example in 406 was on the TV. And so, you know, if you are going to pay weekly on this, and in the end it's going to cost 2 to 3 times as much, a more wise decision would be to pay yourself weekly. The money that you would be paying to the rent-to-own service, pay it to yourself, put it in a savings account, and then when you have enough money saved up, you go out and you purchase the furniture or the TV or whatever it is that you wanted to buy. That would be a much more wise choice. Any questions about those? Go ahead and give me a smiley if you're ready to move on.